get his take on the markets. Philip, good to see you.
Good to be here.
Do you think we're just getting used to the flow of tariff headlines at this point, or?
Well, I think so. I think the shock of they're on, they're off, it's going to be this, it's going to be that. The market is getting used to the chaos of the tariffs, but I think we have to be careful when drawing a conclusion to say, okay, now we can see a relief rally. We can just put the correction behind us, as brief as it was, and just move forward as if nothing has changed in terms of where we were, say, 2 months ago. That's not the case. We have to look at where we are economically and where we are from the earnings perspective going forward over the next, say, 3 to 4 quarters. And from the tariff perspective, nothing has changed, meaning we still are facing significant tariffs in Canada, in Mexico, and other areas around the world that's going to weigh on U.S. consumption, in our view.
And because we've seen the evidence, the confidence data, and companies starting to trickle out with sort of gloomier forecasts or more cautious forecasts.
That's exactly it.
Okay.
And if you look at earnings expectations for the first quarter, they've already been revised down by 5%. Now, that's not to say that we can't get a relief rally. I think we can. We hit a few technical levels last week in terms of the market being oversold. Got close to the VIX breaking above 30, not there yet. So, could we see a little bit of a bounce before maybe another leg, and that leg could come after April 2nd with these reciprocal tariffs that, again, nobody knows exactly what they're going to look like. Yeah, the volatility's not gone yet.
All right, let's just do like the quick math game on corrections and bear markets and just look at it through the lens of the S&P to keep it simple. So we had seen a 10% decline for the S&P, which is an official correction when you come down that amount from your peak, even though we were at these all-time highs after 2 years of, record gains. If you were to decline 20% from the peak, that would be a bear market. We certainly did not see that. But it sounds like you would not be surprised to see additional losses from that 10% level in the interim. Is that what you're saying?
Exactly. And the reason why is historically with the correction, there are a few markers along the way to say, okay, this is the end of it. And then one of those things is the VIX, the volatility index, breaking above 30, maybe getting close to 40. That's what we saw in the fourth quarter of 2018. That's what we saw in 2022, and that's what we saw in 2023 as well during the fall correction there. We didn't get that this go around. So that could say that maybe we didn't hit that peak fear that you want to see at the bottom of a correction to say, yes, we've seen the worst of it. Now it's up from here.
But you don't see a so-called bear market for the S&P.
Exactly. A bear market usually is triggered by a recession. And when we look at the economic data that tends to lead recessions, really there isn't enough evidence there at all to say that we have even a meaningful risk of recession over the course of the next 12 months. Now, tariffs could change that, but I'm of the belief that tariffs are going to be more temporary than permanent.
And we should point out that while we're talking about broader indices that represent the market, there's plenty of stocks out there that have seen dramatic declines from their peak. Tech would be the most obvious example. I only bring it up because we started the week with a bang with investors coming back to tech. Are there any takeaways from those beaten up names that arguably are in bear markets finding buyers, or again, that's kind of the bounce along sort of stage of this market cycle?
No, I think you raise a good point there that you can start to dip into the market, dipping a toe, like when the markets are down by 10%. Yes, it is a good sign to start buying, but it's not the all-in signal that, okay, the pain trade is behind us. We can just start jumping into cheap stocks and just hope for the best from there. But the other thing that's interesting is that when we focus more on the U.S., there's been other areas around the world that have done very, very well. Europe has surprised to the upside in terms of market performance year to date. Asia has as well. Canada has outperformed, the TSX has outperformed the S&P 500. So there are other cheaper areas that are less sensitive to tariffs outside of the United States that investors can take advantage of.
I do want to remind our audience, the TSX is positive for this year. I mean, I know when you're watching every day, and we appreciate people watching every day, there's a lot of volatility. But if you had closed your eyes and just opened them today, you'd be talking about a Canadian stock market that is higher so far this year. There are evidence signs that Canadian investors have actually been gravitating towards Canada amidst some of this uncertainty. If you were going to be more tilted to one market, Canada or the U.S. in 2025, which one would it be at this point, do you think?
I'd be tilting towards Canada. And I think for some of the reasons that you mentioned earlier.
Even with all this worry about the economy and all that kind of stuff?
Well, the Canadian economy and the Canadian stock market are two very different things. You'll hear this from us over and over again. The Canadian stock market is more globally levered. It's levered to commodity prices, whether it be on the energy side or the materials side. You mentioned earlier about copper prices starting to catch a bid, oil prices starting to catch a bid. This is good for the Canadian Stock Exchange, regardless of what happens to the Canadian economy.
Yeah, and our materials sector, which includes a lot of those gold names, has been rocking and rolling this year, so that helps out as well. For those who are watching some of the graphics on our screen, there was a comment there about your view to be overweight on fixed income. What does that mean?
Right. So right now, because of the uncertainty that we see with the tariffs in the United States and the belief that we're not through this volatility, it is prudent to, we believe, to have a slight overweight to fixed income. Bonds are paying, let's call it 5%. That's a great return in this environment. And then once we see the volatility start to ease, once we have the all clear sign, or we're more confident that the tariffs are going to be less disruptive going forward, that's when you can start to shift back into equities. So there's a nuance there. We want to be underweight U.S. equities and overweight other areas around the world, but underweight equities overall, overweight fixed income.
Okay, just a final nuanced question here. But for you and your team, since tariff headlines change every day, are you just putting a policy in place that assumes that continues? Is your portfolio strategy based right now on the assumption that we'll be just caught up in this tense squabble cycle for the foreseeable future?
I wouldn't say for the foreseeable future, but for the near term, yes.
Yes.
Near term being a quarter, maybe two.
Okay. All right. Philip, thanks a lot.
Well, thank you.
Appreciate it. Philip Petursson joining us, Chief Investment Strategist at IG Wealth Management.